The strategic power of turning off notifications. In modern markets, investors are constantly interrupted. Price alerts, breaking news, analyst upgrades/downgrades, social media commentary. These notifications feel informative, but strategically, they often reduce performance. Turning off notifications is not ignorance. It is risk management for attention. 1. Notifications trigger emotional reactivity. Every alert activates the brain's threat detection system. A sudden, market down 3%, notification can trigger fear, urgency, impulse decisions. Behavioral research by Daniel Kahneman shows that fast, emotional thinking, often called System 1, dominates under stress. Notifications force System 1 to react before rational analysis can occur. Silencing them reduces emotional activation frequency. 2. Constant alerts increase loss aversion. Loss aversion, a concept developed by Daniel Kahneman and Amos Tversky, explains why losses feel roughly twice as painful as equivalent gains feel pleasurable. Frequent notifications amplify this bias by highlighting short-term declines, making volatility feel permanent, encouraging premature selling. Less exposure to short-term fluctuations reduces perceived risk, even if actual risk remains unchanged. 3. Attention is a scarce resource. Notifications fragment focus. Each interruption breaks concentration, creates cognitive switching costs, increases mental fatigue. Investment decisions made under cognitive fatigue are more likely to be impulsive and inconsistent. Turning off alerts protects decision quality. 4. Volatility feels larger than it is. Markets naturally fluctuate, but when you receive multiple daily alerts, volatility feels amplified. A 1 to 2% move becomes a situation. Over time, this exaggeration encourages overtrading. Silence restores perspective. 5. Strategic investors think in time horizons, not minutes. Long-term investors, such as Warren Buffett at Berkshire Hathaway, do not operate on notification cycles. Their framework is built around business fundamentals, earnings growth, competitive advantages, long-term value creation. Minute-by-minute updates are irrelevant to decade-long thesis. 6. Notifications encourage action bias. Humans are uncomfortable doing nothing. When alerts appear, they create a subtle pressure. You should respond. This activates action bias, the tendency to prefer action over inaction, even when inaction is superior. Turning off notifications reduces artificial urgency. 7. Silence strengthens process discipline. When alerts are removed, you check markets intentionally, not reactively. You evaluate based on schedule, not stimulus. You operate from a plan, not a headline. This shift increases alignment with rule-based or duration-focused strategies. The psychological mechanism. Notifications transform investing into a series of micro-emergencies. Constant evaluation. Emotional oscillation. Turning them off transforms investing into structured review, planned decision-making, long-term monitoring. Emotion thrives on immediacy. Discipline thrives on distance. Important distinction. Turning off notifications does not mean ignoring critical information, avoiding portfolio oversight, refusing to adapt. It means replacing reactive monitoring with scheduled evaluation. Final insight. In investing, edge often comes from lower costs, better discipline, fewer emotional mistakes. Turning off notifications is a simple behavioral intervention that reduces overreaction, overtrading, emotional volatility. Sometimes, the most strategic move is not a trade. It's silence. Because protecting your attention often protects your capital.